If you have ever felt the stock market is rigged against the little guy, you're going to want to listen to our guest today. Randy Tate is a serial entrepreneur. He grew up on a farm in Northern California. He was the first in his family to go to college. Later on, he founded a company called Game Day Athletics and took it to $5 million in revenue before a successful exit to a public company. Then he served as an executive at Infusionsoft and helped them scale the business to more than 150,000 users. Now he's focused on his biggest challenge yet, using AI to automate wealth creation for small investors. So today we are going to be diving deep into the future of money, the end of buy and hold, and the power of smart technology for small investors. Randy Tate is the CEO of iFlip. Randy, thank you for joining us today.
Thanks for having me. I'm really excited to be here.
Thank you. Thank you, Randy. You co-founded iFlip about 10 years ago. Give us an overview of what does iFlip do, Randy, please.
Yeah, iFlip there's some interesting caveats where we'll dive into, I'm sure. We use, and I'm going to use the word real because all AI is not equal. We use real AI to do predictive analysis, execution, and automation for people who want to invest in their future in the stock market and take advantage of what the U.S. stock market in particular offers them.
Okay. I'm sure we'll dig a little bit more deeper into this, but tell me a little bit about your background. I know you grew up in Northern California on a farm, Game Day Athletics. That background led you to your current mission of using AI to automate wealth for everyday investors.
Yeah, I'll give you the 3-minute overview for the sake of time. My background goes back a little. After being raised on a farm in the environment in that world, I did go to college, but in truthfulness, I went to college just to play football and wrestle. I was the proverbial athlete that wanted to just play. And after college, I went into teaching. I love teaching and coaching, coach football, coach wrestling, spent almost 10 years doing that. And then I realized as I got older and more experienced around the world that money is more important than I gave it credit for early on in my life. And so my superpower, if you will, is making things easy. And I looked at the business models and what was going on in the sporting goods distribution area, of which I knew nothing about, but I saw where it was broke. So I found myself somebody that knew the specifics of that industry, partnered with them, jumped in very quickly. We only had that company for a few years and we sold it to a publicly traded company because we created a new way to do business in that space, which is now used today all over the country. I took that information, that knowledge, started another company educating and training leaders and business owners on how to grow a company. It seemed pretty simple to me. I don't have a business degree, but the logical pieces, and I just wrote a piece on LinkedIn about a week ago talking about how everything I needed to know or needed to learn about running a company, I learned coaching high school football, because it really boils down to a handful of things: putting the right players in the right positions with the right mission. And if you can do that, it's industry agnostic. How I got here is very interesting. I had sold that second company to Infusionsoft, the big software company. I was working there, and I met one of our co-founders. And he had spent 30 years on Wall Street as a quant. And he ran the global risk desk for Deutsche Bank. And he'd been all over the world managing billions and billions of dollars. And he said one statement to me, and this is something I want all your listeners to keep in mind. Wall Street passes the risk of investing to Main Street. Say it again. Wall Street passes the risk to Main Street. How do they do that? They do it in two ways. Apps like Robinhood, they encourage gambling, bad behavior, but it's become predictable. So the markets can maneuver around it. It caused problems early on. But the biggest way they do it is in the traditional. Now, I'm not poking at the financial advisors all of them. But in general, places like Schwab, Vanguard, Fidelity, BlackRock, the institutions do not invest their money in the products they make available for the public to invest in. They have a team of people, advisors, out selling their product, and they sell it in a way where it's trackable and predictable so that they can invest their own money around it. That's how they pass the risk off. We decided to build a software platform that will invest with the efficiency of an institution or a hedge fund, but be as easy to use as Robinhood. And that's where this whole thing came from. We're going to make people's lives better because they're going to have better performance and risk management. Less expensive. We're going to be SaaS. We only charge $7 a month, and easier to use than a Robinhood. And that's the approach we were taking. And that's how I got into this business, was by that one statement. I'm like, well, why don't we just build some software that does that for people? Well, that's a great idea. Let's do it.
Wow, that's interesting. Now, actually, tell us about iFlip. What actually does it do? And as an investor, if I open an account with iFlip, what do I get? Take us through the journey, briefly as you can, please.
Yeah. So if you open up an account at iFlip and you want iFlip to help you manage your money, because it helps you. We don't give advice. We're not regulated. I don't tell you what to invest in. Our system is what we call smartfolio based. It's a portfolio, but it's smart. So these smartfolios are, think of them as a bucket of stocks and ETFs. Most everything's in the S&P 500, Dow, NASDAQ. It's all the names you know. And then it's composed based on your risk tolerance or sector or theme. We have one called red oil. You can probably guess it's just in oil, energy. We have one called BitFlip. It's in Bitcoin. It's the little plays on the words like that. And how it works is this, and this is where it gets really interesting. The talking heads in the world will tell you that AI cannot predict the stock market and is not good for managing it. That AI is only used on the marketing side, the customer acquisition side, customer support. They're partially right. ChatGPT, Gemini, Claude, those are all non-deterministic language models. And those cannot predict the stock market very well. They're terrible at it, actually. What we do is very different. We don't have a language model. We have a math physics model. And it's also not open source. So people can't prey off what our AI is learning. It's our own. We run on an entire cluster of our own. It's 3 nodes, Virginia, Florida, and Arizona, all running on Nvidia Blackwell machines. And we are crunching an enormous amount of data. Let me give you an example. Apple happens to be in one of the smartfolios, which it is. We call it Big Tech. It's just the Mag 7. That Big Tech has Apple. It has a certain allocation to Apple inside that smartfolio. Every single night, the AI runs over 800 indicators for 20 years. Now, let me explain why we run it for 20 years. This is not a back test. You've heard of back tests? You're familiar with the statement? You cannot back test AI. It's not possible. If you try to back test AI, guess what? It's pretty smart. It'll cheat. It cheats every time, and it'll give you a perfect score. So you must do what's called a forward walk. So you go back 20 years, and you give the AI all the data that happened prior to that date. Now, it could be things like Fibonacci sequences, Bollinger Bands. It could be moving averages. It could be correlations to other symbols. Each symbol has over 800 of these. And then it only gets all the data prior, and then it must make a decision for the next day. It develops out of that 800. It's going to boil it down to the top 30 to 50 that are indicating tendency towards risk and towards volatility. We're looking to reduce volatility and smooth out the curve. And then it builds a model for the next 15 days. It then determines whether or not it should be in or out of that symbol. and it will buy and sell automatically. It doesn't send you a signal to go buy on your own. It does all the execution for you as well. And then it does the same thing the next day. And it runs those every single night so that every single morning before the market opens, the AI determines, if it's in a smart folio, which symbols you will own and not own. And it will buy and sell accordingly, fully automatic.
Would that be almost like high frequency trading?
No, not at all. Doesn't trade very often. In fact, the AI wants to be long all the time. It only makes a trade if it predicts or sees a 10% or greater risk of a downturn. For instance, last year, when you might remember what happened to Nvidia when a DeepSeek was announced. Well, what people don't understand is there's mathematics that are already baked in before the announcement, because somebody knew. Some people knew. Our AI sold Nvidia the day before. Did the same thing with Oracle last year. And then it got right back in. And before COVID, late December, we sold 80%. The AI sold 80% of everything it owned and went to cash and skipped January, February, and most of March, just sat in cash. My customers are yelling at me, why are we in cash? We should be in the market. We can't make money if we're not in the market. I'm like, well, if it's going down, you're not making money. You're losing money. So it bought back in March, and we had a great year in 2020. We did the same thing this year. And so the idea is not just AI. It's specific AI built in a deterministic fashion. That is the key word, is deterministic. You could run it 100 times. It's going to give you the same answer. You ask ChatGPT 100 times, you might get 100 different answers. And so that's the idea behind it.
So if you are a rep model sold Apple, or just for example, and then the market doesn't know why they sold it and it just going to cash, would you from the inside would know which signal that has picked up out of those 800 and why they have sold it?
Yes, but that is a monstrous amount of work to go pull apart. We've now been running it since 2019, and we know what the indicators are. We can go pull the scattergram apart and figure out which ones it did. But then there's the next generation. So now what we're building now is that's just building on a single symbol. So now we take that single symbol and we ask the machine, okay, machine, which ETFs is this symbol in? And we pull all those ETFs. The theory is the tail wags the dog. The ETFs are going to force movement of that symbol in large volumes. So now we can map that against it and all the indicators on all those ETFs. And we can take longs, we can take shorts, we can take 10 different ones, and we can have the AI run it in such a manner that it will pull every possible combination of 7 ETFs and 7 longs, 5 shorts. It will pull every combination of buy, own, sell. What should you do that predicted the movement of the symbol we're trying to predict? And we can find some that might higher overall performance, but with crazy drawdowns. So we don't want that. We want a smooth journey up and to the right without the big drawdown. So to pull out the actual indicator that tipped it over the edge to say that, we could, but we don't do that.
How did that react last year, for example? We are in 2026. April 25, when the tariff announcement came, did your AI pick those signals beforehand?
Well, let me pull it up. I'll look. And remember, we were in various symbols in different smart folios with different risk allotments so that we can, I'm pulling one up right now. So if you just take the big tech, the Mag 7, second quarter of 2025, so April, May, June, we're up 21.9%.
And what would that be in comparison to the actual stock performance?
The actual stock I don't know the numbers off the top of my head, but they were mostly down.
Okay.
They were mostly down. So
And
they were down about 12%, I believe, the first quarter of this year, and we were down 1%.
so you've been doing this since 2020. That's around about the coronavirus phase. So it's been 6 years now, give or take.
Yeah.
So what has been the performance, Mag 7 or S&P or whichever you want to pick, any of those segments?
Yeah.
What has been the performance, iFlip versus the actual?
The best year I can tell you is 2022. The market was down about 20%. We were across the board, if you took all of it, we were down about 3%. But many of our portfolios, like the Mag 7 in 2022, was up 20% for us.
Okay.
Which is a big number. We're not trying to be, I don't want people to get enamored with returns. I want people to get enamored with beta. And if they don't know what beta is, I'll explain to your viewers. Beta is the risk correlated to the S&P 500. And most, for instance, that 20% return on the Mag 7 in 2022 had a beta of 0.71 on the Mag 7. Now, I can tell everybody on this call, if you went to your financial advisor and said, I want a portfolio that's going to beat the S&P 500 with a beta under 1, they would tell you to go join a hedge fund.
Well, I'll be scratching my head. So I want to know how the math works. So 0.7 means that beta 1 actually means exactly the same as S&P.
Correct.
So more means 0.7 means less. So how do you beat S&P with 0.7 beta?
We beat it with 0.4 beta.
Okay, explain to our viewers, how does that work? How does that happen?
It's about, it literally boils down to one thing: predicting the downturns and skipping them.
Okay.
It is truly about predicting. That doesn't mean you don't go down. This is not an always up revenue producing machine. We're not trying to be a day trader. We have one portfolio called Yield Shield. It's just treasuries. Almost no movement at all. Pays 4.5% dividend, was almost zero risk. The only thing you're being protected from is a potential black swan, which how often do those happen? But for people that just want to park their money and don't want to take the 3% the bank gives them in a CD, that's where it goes. And so everything is not 20% returns a year. That is not, Mag 7 is very volatile. I use them as an example a lot. But if you just take our regular balanced core smartfolio, it is not tremendously ahead of the S&P 500, but 2022, up 10%. Currently year to date, up almost 5%.
Okay.
Beta, flat at 0.5.
Wow. So tell me, we are recording the first week of May 26th. So what are those indicators telling us going forward in the immediate?
They change every day.
Okay.
So literally it's a new data set every single day. And that's what the machine's been learning. And it went, some of them, that same portfolio that I was telling you about is up 4.4% in Q2. So April and May, month and a half. We're not designed to be home run day traders or stock pickers. Our AI is really doing, if I boiled it all down, it's understanding the fact that institutions have been algorithmically trading these high volume signals like the Apples and the Facebooks for years, since the 80s. So there's a lot of data there. And if you know what data to look at and you know how to interpret it, you can predict statistical likelihood of bigger downward movements. And that's all we're trying to skip. A big chunk of the S&P earlier this year.
That makes sense. Now, let's just take a transparency, Randy. You said at the beginning that you charge $7 a month.
Yes.
So how do you make that work?
Here's where people don't understand. The reason advisors charge $1 to 3%, and every mutual fund has a fee on it, and every ETF's got a little tiny fee on it. Can't do anything about those. Obviously, if you're invested in an ETF on our platform and you got that 0.0002 basis, you're going to pay that. That's negligible. The reason we're able to charge $7 is at full scale. When we get to $500 million, I won't need more than 50 employees. We don't just use AI on our trading. We use AI everywhere. And we won't need a bunch of people. That's number one. But real revenue also comes, and I got really frustrated when we first started this company because the broker, the introducing broker dealer, was charging an asset-based fee just like an advisor. We're going to charge them 1%. Well, I don't like that. So I bought the broker so I can change their model too. I've converted everything into a flat fee model. And I really want to help the little guy. I really do. Everybody on our team's had exits. We're obviously making money, trying to make money, but that's not the sole focus. I want everybody to be able to participate in the market and have a chance at real retirement. If a 20-year-old puts their money on our platform and they're working at a fast food joint and they've only got $500 or $100 a month to put in, and they put it in a Roth IRA, and they do that until they're 59, they will retire a millionaire because of our technology. No advisor in the world that's any good will take them or will manage their money for $7 a month. Now, once their account gets to $10,000, the broker is going to charge them $10 a month. Transparent, fair. They're going to pay $10 for brokerage, $7 for software. And then the broker will scale that up to a point. At $100,000, you maximize your brokerage fee at $140 a month. Your software is still $7, which comes out to about $1,500 a year, which is 1.5%, but it never goes up after that. So the percentage of money you pay over time continues to get smaller while your assets get bigger. We get about once a week, somebody moves their account from Ken Fisher, Charles Schwab, Vanguard, where they're paying 1.5%. They move $1 million because they're paying 15 grand a year in fees. And with us, they pay 1,500. So we're not trying to just be someone that gives everything away to the less fortunate or gives big breaks to the super fortunate. We're making a fair, even playing field. I don't charge them more on the software side because I have no more work to do. If you have $500 on my platform, or if you have $5 million on my platform, I'm doing the same amount of work. Why should I charge you different?
Fair enough. That's good. Now, you guys are based in the USA. So I'm guessing your clients are, if the people are listening, say in Europe or UK or elsewhere, they can have access to your platform or only for the US?
Yes. It's all in the US stock market. But if you're in other countries, yes, you can. Not every country. We've got a list. So if someone wants to reach out to me and ask me, the main countries, of course, UK, UAE, the main countries, of course, we can. Brazil, we definitely can, because we just opened up a bunch of stuff down there. And if people are down in certain parts of Europe that want to, get a hold of me. I can start the process to, at some point, we will be. This is the way money will be managed in the future. The manipulation ability of the market will go away.
So that brings me to the question, Randy, is your software, your AI, do the fundamentals of the companies as well, or just the signals on the market?
Both. Price matters.
Yeah, the value matters.
Yes.
Yeah. Okay. Now, for decades, people have been advising on the portfolios in terms of 60-40, 70-30, 80-20, wherever there is. There usually has an element of equities, the bonds, the cash, and so on. So what's your view on that? And do you follow the same methodology or you have your own?
We have our own. We say modern portfolio theory is dead, as is the 60-40. I wrote a LinkedIn article on that about 2 weeks ago. Literally, I called it the 60-40 is dead. Volatility is much greater than it ever has been. And uh, the ability of quants and computers now makes it a much faster decision-making process. Bonds do not necessarily provide you a hedge against the S&P 500. The one goes up, the other stays stable. You can participate in both at the same time. You can create alpha where previously there was none. And that is what a good hedge fund manager does. Hedge fund managers don't put you in a 60-40 split. They actively manage and they avoid the volatility and smooth out the curve.
Okay, that's interesting, very interesting, because you are very AI heavy. People like Bill Gates say that AI is the biggest tech, basically the shift in our lives that has ever taken place, or certainly in his lifetime, and probably most of us as well. So what specific trends are you seeing when it comes to AI in the fintech space you're in regarding the AI adoption, how the things are moving and changing? Of course, you're making things happen. So you're seeing the same trend elsewhere as well?
Yeah, everybody's using it, but they're using it in different ways. Right now, the biggest trend in fintech is AI, but it has nothing to do with money management. It's AI around integrated internal systems, marketing, sales, customer support, customer outreach, social media. It's all about the presence and the stuff ChatGPT and Claude they're really good at. At this point, there's very little to do on the AI front on the actual investment side. And I've had conversations with people in well-known institutions that don't think a deterministic AI is capable of being built. And so that's the next generation of it, is where we're at. I'd like to think we're 5 years ahead of everybody. As soon as they actually turn their attention to it, though, and start dumping massive money into it, this is the way it'll go. And it does go back to those white collar jobs. Some of those white collar jobs, those quants, just like the TV producers, the graphic artists, AI is slowly being able to replicate and outperform the masses in that space. What they don't realize, and here's the thing I want to make clear. I'll use a basketball analogy. Phil Jackson was credited with developing the triangle offense, the coach of the Chicago Bulls. He created this new offense that was unbelievable and was dominating the NBA. What they don't tell you is he had Scottie Pippen and Michael Jordan to run it. And when you've got the two best players on the team, your offense is going, he could have ran any offense he wanted and won. And then he proved his worth and how great he was by putting the triangle offense in LA and having Kobe Bryant and Shaquille O'Neal run it. It's like, wow, see, look how great and look how ingenious this offense is. But the reality is you got to have better players. And better players means who are the people developing the indicators inside the software? Who's doing the math? It's not all equal. The people that better build the AI, not open source. If it's open source, it's free game for everybody. You have to understand that the fact that our AI never touches the internet is extremely important to us because we don't want other people to see it or know what it's doing. And so where the industry is going is it's going to continue to evolve in the operational aspect of the day-to-day business, just like every other business in America.
Okay. So when it comes to the operations side, you guys are using AI internally as well in your own operations, sales, marketing?
Of course.
Things?
Absolutely.
Okay, that's good. You touched on that earlier in this conversation, that people, they've been advised to buy and hold for a long time, 10 years, 20 years, etc. So your AI, your technology follows the same principle or different?
Combination. Buy and hold is great. We subscribe to investing for the long term. So if you buy into a smart folio, you're buying and holding a bucket of stock. Now, inside that bucket of stock, though, not all stocks go up all the time. So it may be time to move one out, move one in. It may be time to own one, not own one. And so it becomes much more fluid, and AI gives us a fluidity that we never had before. There's a couple of myths that advisors use today. They tell you to buy and hold because you can't time the market. Well, that's not correct any longer. You can, in fact, within a range, time the market. It is predictable. That's number one. And they talk about tax implications. Well, if you sell it, you can have a tax implication. So the simple question is, would you be happy to pay $100 in tax to save $200 in your portfolio? That becomes the question. We had a person last year on our platform. They made $80,000 on our platform in short-term capital gains. And he was mad because he had a $40,000 tax bill. Well, okay. So let's go back and look. If he'd have bought and held, he'd only made 20 grand. So which would you prefer? Would you prefer that 20 grand with no tax implications in your account? Or would you prefer the 40 grand that you had to pay 40 grand for that you already had because you made it? That becomes the conundrum.
So I guess the many investors saying actually they play with the emotions of the market because technology doesn't use those emotions. So that's why also technology helps them actually make more money, looking at lots of data and signals at the same time. Very interesting. That's very interesting.
At some point, that'll happen. It has to. They're Blockbuster, we're Netflix. At some point, they're going to resist this as long as they can. Why? It costs them money. It costs them jobs. It will get to that point. We're young. We're a little company. We've barely got $100 million on our platform, 2,700 customers, 2,800 customers. We're raising capital ourselves. We're trying to grow and expand, and we're in our Series A funding round. And so we're trying to finish that up. We need more money for marketing. We've grew at 400% in 2024. We doubled last year.
Wow.
And we haven't spent money on marketing yet.
So where are you finding those customers? How are you getting the word out?
I speak on a lot of stages at a lot of events, and I've got some really good partners now that have big audiences that share with their audiences. And as we start to expand into the advisory world, we have a version for advisors that they can use now. We have a partnership with the IRA Club. We've built a system where we can set up 401k plans for small businesses, where they can self-direct their 401k plan and use the iFlip software. And as we continue to grow through those various channels, we're just growing like crazy.
That's very good. So do you see at some point, maybe 10 years from now, that human stock brokers become obsolete?
No, I don't think so. Often advisors think I'm trying to put them out of business. I'm trying to give them a tool to do better. But I had a friend of mine who is an advisor say, look, man, I said, Randy, my clients are going to use me. Most of them aren't going to leave. Even if your software is better, less expensive, and easier to use, let me help them. Let me help my own clients. And that made sense to me. And so that's why we built over the last year an advisor interface to help them.
So what does that interface do?
Same as a retail customer, except they have a different interface. So they're going to build out portfolios and we'll customize for them. We can build, they can tell us what they want. We'll see if the AI says yes. And we'll build them their own portfolios, let them have access to manage it. And so their client's money all lives on our platform at our broker, but the advisor can charge them their 1% fee to manage it for them.
Okay, that's good. Wrapping things up, Randy, when people think of Randy Tate and iFlip 10 years from today, what's the one thing you want them to say about you?
I would like them to be grateful for what we've built, because this has taken a monumental effort to build this tech so early on and be on the front end of the industry. I want our customers today in 10 years to be just grateful that they found us, grateful that they've used us. And I want the industry to recognize that we disrupted the whole thing.
From your long experience of being a serial entrepreneur, what piece of advice would you give to other CEOs trying to bridge the gap between where they are and to the AI-driven future?
Get their message correct. If you're going to grow, your message has to resonate at minimum one of three things: that you're better, that you make somebody's life easier, or that you cost less money. If you can't stand on one of those, it's going to be difficult. If the competition is better than you and you're more expensive, and it's going to be hard. If you can do all three, and this is where we started at iFlip, we started with this premise of doing all three. If you can be better, you can be less expensive, and you can make their lives easier, you'll disrupt an industry.
I agree. I totally agree. And a very powerful takeaway. If people want to find you, how do they find you?
Yeah, just go to our website. It's iFlipinvest.com. iFlipinvest.com. You can find me on LinkedIn, Randy Tate. Follow us on YouTube. We have a lot of videos on YouTube talking about the markets. There's videos on there. Friend me up on LinkedIn.
And finally, one more question is, do people need any minimum amount of money to start investing with you or not?
Yes, they do. $500.
Okay, that's a minimum. And then the maximum, there's no maximum.
No maximum.
Okay, that's great. And Randy, appreciate it. Thank you for your time today. And really appreciate it. I'm sure many people will find it very useful. And I personally think that your platform is amazing.
Thank you.
Thank you very much. You take care.
I will.